Hello and welcome to Impact Code with Alex Okyere. So in this and maybe the next few episodes, I want to take you through personal income taxes. So I've titled this next few episodes, Understanding Personal Income Taxes, a guide based on Ghana tax laws. And let me just start with a disclaimer. This does not in any way replace the need for the services of a professional accountant when you need to file your annual taxes and do your tax computation. This is just an overview for you, for your understanding. I'm going to cover about four main topics. I'm going to do an introduction to personal income taxes. I'm going to look at taxable income and the various tax rates. I'm going to look at the filing requirements, what you're required to do in terms of filing your taxes. And then I'll take you through a live, calculation of your personal income tax. So this is purely based on the Income Tax Act of Ghana, Act 8896 of 2015. So everything we're going to go through here, like I mentioned, is based on guidance from the Ghanaian tax law. So first thing you need to understand is that tax is law, right? Tax is law, and then compliance is not optional. Even in the Bible, Jesus paid tax, right? He got to a place where they were asking him to pay tax. He asked some of his disciples to go fish. They got a fish, opened the fish, there was money, they came and paid tax. So even Jesus paid tax, right? So you need to understand that tax is law, and as a law-abiding citizen, you need to understand your obligation in terms of paying taxes. So in this case, what I'm taking you through is personal income taxes, right? The taxes that you're supposed to pay as a person. So broadly, you can have two broad types of taxes, right? We have the direct tax and the indirect tax. So direct tax is mostly on your income, and indirect tax is taxes on consumption. So as you consume various commodities and services, you pay taxes. And then direct income tax is the one you pay on your earnings, on the income that you make. So two broad types, direct, indirect. So under the direct, then you can have personal income tax, which is PIT, we call it PIT in practice, personal income tax, and then CIT, which is corporate income tax. So personal income tax is the one that you're supposed to pay as an individual, and that's what I'm going to dwell on now. And then we have corporate income tax for companies. Then under the indirect tax, which is more of, on consumption, so you have the various indirect taxes and levies, VAT, NHIL, Get Fund, CST, etc., and all those other levies that you pay on consuming fuel and all that. So income tax, personal income tax. Who is liable? Who is supposed to pay personal income tax? So personal income tax is payable by a person for each year of assessment. And as I go through, I'll be explaining some of the key terminologies. So personal income tax is payable by a person for each year of assessment on his or her chargeable income or taxable income for the year, or in some cases, what we call final withholding payment during the year. So what is chargeable income? Chargeable income of a person is the total assessable income of that person, less deductions that are allowed under the law. Assessable income is simply your income as a person from three sources: from employment, from business, or from investment, right? So your assessable income is your income from employment, business, or investment. So like I mentioned, we take your assessable income and then we consider some deductions that are allowable under the law. And then that final number or amount, which is the assessable income less all the deductions and reliefs, is your taxable income or your chargeable income. It's the same thing. A resident person's assessable income is that person's worldwide income from all sources. So if you're a resident person in Ghana, the income on which you're supposed to pay taxes is your worldwide income from all sources, right? If you're not a resident person, your assessable income is your income from Ghana. So you're not resident, considering Ghana, then in that case, your assessable income is the income from Ghana alone. Then also I mentioned final withholding payment. So withholding taxes are deductions that someone that is paying you for your service or that's paying you for any earnings or income you've earned deducts from source and pay to the tax authorities. This is the way it works. Let's say you've done some work for somebody or a company. That person has to be what we call a withholding agent, right? That has the right to withhold a part of the payment they're supposed to make to you for the services you provided and pay that to the tax authorities. So what happens is, let's say they're supposed to pay you 100 and the withholding that's applicable for that particular service is 7.5. They will take 7.5 from that payment and pay you the remaining amount and pay the 7.5 to the government. So at the end of the year, when you're doing your tax computation and filing, which we'll go through later, you go through and say, okay, this is the income I earned. I earned 100. These are my allowable deductions. This is my taxable income. And you apply the tax rate on it to determine your tax liability. And then you take out or you net off the withholding that has been already done at source to arrive at the amount you're supposed to pay, your final tax liability, what you're supposed to pay to the tax authority. So that is temporary, right? But we have another, or the law also provides for other or certain payments where the withholding is final. So for those amounts, you don't come back at the end of the year and say, okay, you want to offset. It's final, right? So as the income or the earning on which the withholding was made. Withholding on these payments are final, right? So dividends paid by a resident company is final. So withholding on that payment is final. Rent paid by a resident individual under a lease of land or a building, that's final. Rent paid other than rent received in conducting a business of sale or letting. Payments made to non-resident persons that are subject to withholding other than payments derived through a Ghanaian permanent establishment. Payments made to a subcontractor under petroleum operations, and payments made to a person in respect of examination, part-time teaching, supervising, examination, endorsement fee, among others. So these payments or this income on which there's a requirement to withhold, the withholding on these payments are final, and you will reflect that when you're doing your final tax computation and filing. A summary of what we've discussed now. We're talking about personal income taxes. Who should pay the tax? Resident individual on your worldwide income. If you're non-resident individual, on income from Ghana. So on which income are you supposed to pay your taxes? It is 1, employment income, it's 2, business income, and it's 3, investment income. So all of these are considered and we take out allowable deductions, which I'll take you through from these 3 sources of income to arrive at your taxable income on which the tax rates are applied to determine your tax liability. And then also on final withholding payment during the year, like I mentioned earlier. For which period are you supposed to pay tax? We call it the year of assessment, and it's simply the calendar year in Ghana. So in Ghana, it's January to December, which is the same as the calendar year. That is the year of assessment. We assess your income for that period, and then we determine what you're supposed to pay as taxes, and then you file your taxes and make your payment. Let's go to assessable income. So we've mentioned assessable income as those 3 main or 3 sources of income, right? The income from employment, income from business, and income from investment. So income from employment could include your salary, wages, leave pay, commissions, gratuities, overtime pay, bonuses, and any other benefits in kind that you receive or allowances in cash that you receive from employment. So you're employed and then you get these benefits, salary, wages, etc. That's what we call income from employment. The tax on this is subject to withholding by the employer. So what happens is that every month when the employer is paying you, they withhold a part of this payment to you and pay that to the tax authorities. So like I mentioned, when you're doing your final tax computation and filing, you will say, okay, I earn 100 from employment. My employer took out X of that and paid to the tax authority. So after calculating my taxes, this is tax that was paid in advance that you offset to determine your final payable amount that is supposed to pay to the tax authorities. So I'll take you through how that payee system works. It's pay as you earn, right? Then income from business. So if you're doing any business, let's say you have a side hustle, you're a sole proprietor, you have some business on the side, any gains and profits from that business for the year of the assessment, the year we're talking about, you're supposed to pay tax on that. So that is the second part, which is income from business. Then the last one is income from investment. So if you've done any investments, you've bought any, bonds or anything, you have investments and you're paid dividends, you're paid interest. I mean, you get your annuity payments, any investment you've done from which you get income is also taxable, right? So that's called income from investment. So accessible income, like I mentioned, 3 sources: income from employment, income from business, and income from investment. This is what we'll calculate and determine all the allowable expenses, under these offset, get to your taxable income on which we apply the tax rates to arrive at your income tax liability. Then one other thing you need to understand when it comes to taxes is cash or accrual basis of accounting. How do we account for your income and expenditure when we are determining your taxes? What is the taxes you're supposed to pay, right? So we have the cash or accrual base. It's very simple. Let me mention what the law says first, and then I'll explain to you what cash and accrual basis mean. So an individual shall account on a cash basis when ascertaining their income from employment or investment. Companies shall account for tax purposes on accrual basis. A person other than a company shall account on either a cash or accrual basis, whichever most clearly reflects the income of that person. So what is cash or accrual? So let's give an example. Let's say you went to you have some side hustle that you maybe preparing a proposal for a certain company, and you sent your fee. You've done the work. You've sent your fee in, but the company has not yet paid you. But you've done the work, right? So you've earned the income, but you've not received cash for it. So if we were doing your books on accrual basis, we'll record that amount as an income, even though you've not yet received the cash. So we've done it on the accrual basis, right? We're accruing for the income, even though you've not received cash for it. That's accrual. Cash basis is you only account for it when you receive cash. So those are the 2 different ways of accounting in terms of income taxes, right? So it's either you're doing the cash or accrual basis, but the law is clear that individuals shall account on cash basis, and then companies shall account on accrual basis, right? So as an individual, if you went to do that work, and you went to do that work within that the period of assessment, and you didn't get the cash from that service, you're not supposed to account for it in that period. You account for it when you receive cash for the service. Okay, let me end this episode with what is the importance of personal income tax. Like I mentioned, tax is law. Compliance is not optional, but it's very important as a country, as individuals, to raise funding, for various government services. So number one, income tax or taxes are important for funding government services, right? So these taxes are crucial for funding essential government services and maintaining infrastructure for the public, right? So tax is important for that. Number two, it's a way to distribute wealth equitably, right? So equitable wealth distribution. Personal income taxes help in ensure an equitable distribution of wealth within society, which promotes social welfare. So if we're all building our roads that we will use, for instance, I'm sure some people will have more money to build better roads. Some people will not have money. But if we take from everybody and build a road, we all use that road, whether you are rich, poor, sick, not sick, everybody uses that road. But if we said, okay, everybody should build their own road to use, some people will not get roads to use, right? So we take taxes from everybody and build the roads so that all of us can use. It's a way of distributing wealth in a more equitable way. That's number two. Number three, for economic growth, right? The tax system also strives to stimulate economic growth by providing incentives for businesses and investment. So we use the tax system to incentivize businesses to invest in certain areas that we want to see economic growth in. Okay, so essentially what I've taken you through an overview of personal income taxes. First, I explained broadly, the two types of taxes, direct, indirect. I've taken you through personal income tax, who is liable to pay the taxes, on which incomes are you supposed to pay the taxes, what is allowable as deduction, and then arriving at your final tax liability. In the next episode, I'll take you through the tax rates and then also take you through a live computation of personal income taxes.